Well, for some more analysis now on those decisions by the ECB and the Bank of England, I spoke earlier to Stephen Koukoulas, Managing Director at Market Economics. Stephen Koukoulas, thanks for joining Business Today. Quite a surprising move, really, from the ECB President Mario Draghi commenting on future interest rate moves. He ditched the ECB's policy of not pre-committing on policy.
Yes, it was an odd move, but one that a lot of other central banks around the world have to some extent anyway, in giving guidance on where they're thinking, not just where the economy is going in terms of GDP and inflation, but also where they're wanting to set policy. And I guess in the context of the last month or two, when we've had this extreme volatility in the bond markets, share markets have been bouncing up and down 1 or 2% per day, I guess it's an attempt to just put some calming influence through the markets, that the ECB is not about to be tightening policy anytime soon, and on the contrary, they're going to keep policy very easy until the economy does actually get some traction.
But in some ways, it does lock policymakers in. So is it a good strategy?
Yeah, look, I think it's not a bad strategy. You've got to remember that the Eurozone's had 6 consecutive quarters of negative GDP. The unemployment rate's at a record 12.1%. The economy's in pretty bad shape. So, in a sense, trying to do whatever it takes, if you like, to get confidence back, to get businesses spending and hiring again is the name of the game. And obviously there's only so much you can do with interest rates at a particular level, and with perhaps quantitative easing as well. So sending out a signal that firms can comfortably borrow money for the next couple of years, knowing that interest rates are going to be remaining remarkably low, is just another step in that direction of trying to just get a bit of confidence back, get a bit of borrowing back and spending back into the Eurozone economies.
Well, the move certainly did inspire a lot of confidence among European investors.
It did, and we've seen the stock markets jumping, 2 and 3%, depending exactly where you're looking. So that was a good sign. Again, it's one of these wealth issues there. And interestingly, too, it's actually seen the euro weaken a little bit more. One of the problems that the countries outside Germany, anyway, were having was that the euro had been strengthening, with the US Federal Reserve now talking about the possibility of tapering off their quantitative easing. We'd had this position where the US dollar was strengthening. The euro is sort of getting caught in the backwash of these currency flows. So to the extent that the ECB is wanting to see the euro weaken a little bit, which helps their competitive position and helps their economies to recover, that's probably some good news too.
But it should be said, Mario Draghi gave no real indication of how long ECB rates would stay at record lows.
No, he didn't. He just said that extended period of time. And I think there was a question at the press conference, does that mean 6 or 12 months? And he said, no, it'll be longer than that. So, it's one of those ones where it'll be a year or 2 or 3 of these very low interest rates. The critical question is, it's rather than sort of the number of months or years that interest rates are going to stay low, I think it's more interest rates are going to stay low until the economy shows some clear signs of improvement. I think that's the way that the markets are starting to view this scenario. A little bit like in the US, where now the economy seems to be moving to a better growth path, and we're now speculating about when the Fed will start to withdraw their stimulus.
And Stephen Koukoulas, we also saw the Bank of England also gave a clear indication that its interest rates will stay low. Mario Draghi says that simply comes down to a coincidence. Do you think that's the case, or could there be some sort of aligned policy making happening there?
Oh gosh, it's a funny coincidence. I suppose the Bank of England have got a new governor, Mark Carney, sort of zipped across there from the Bank of Canada, and this was his first policy meeting. So, look, in a way it doesn't really matter, because I think one thing that both Mark Carney, when he was at the Bank of Canada, now at the Bank of England, but also Mario Draghi may have learnt, is how constructive, if you like, the Fed has been in the US with its policy guidance for many years now, 3 or 4 years I think it is. They've been saying that interest rates will stay near zero levels. They've actually given guidance on economic parameters that they've got to see before they start withdrawing the stimulus, and that is getting the unemployment rate down to 6.5% before they start scaling back on the monetary policy stimulus that they've got. And obviously tonight we've got a jobless number coming out. So, and they've actually got their economy doing much, much better than either the UK or the Eurozone. So that guidance that the Fed has given has ensured that investors and companies in the US have been able to borrow money at very low rates, knowing that rates are going to stay low for a considerable time.
Yeah, I guess with all the economic problems in Europe, the ECB and the Bank of England really didn't have any choice anyway. But I want to talk about the US economy briefly, and we had currency strategist John Noonan on the show yesterday. He says anecdotally there is a lot of good signs for the US economy at the moment.
Oh, yes, anecdotally, and even in some of the hard numbers that have been coming out on house prices and consumer confidence, these are at sort of 5 and 6 year highs. So we're seeing at long last some real traction being gained in the US economy. And certainly the people that I speak to over there in the market still are suggesting that there is some genuine confidence and traction returning to the US economy. I guess this period of 5 years of zero interest rates and the bond buying program and are sort of generating the sort of growth that they want to see. So maybe this time around we're seeing the US actually getting back on its feet, and hopefully in the next couple of years the US will be returning to a 2.5% to 3% plus growth pace. And if that's the case, it's going to be good news for the world economy, because the US is still the biggest country in the world.
Well, we've already seen some encouraging signs on the property market in the US, and tonight we'll get an indication of how the non-farm payroll figures will pan out. That'll give us a good indication of how the labour market's looking.
Oh, indeed, and that's arguably the most important number that we ever see from the US each month or each quarter. And the market again is looking for an increase of around about 170,000 for the month in terms of new jobs, and the unemployment rate currently around about 7.5% to keep edging a little bit lower. It's not going to fall rapidly, but it's starting to fall from the peak of 10%. So I guess if we see a number about that sort of level, the unemployment rate staying on this trajectory towards a lower rate, then I guess that will give the market some confidence as well, other than perhaps this fickle nature of the markets that we see from time to time, where good news on the economy is treated negatively because it's seen to be a step closer to the Fed withdrawing this super stimulatory policy that's in place.
OK, Stephen Koukoulas, thanks very much for your time today.
Thank you.